Well, the first thing I'd say is that even if you're not let's say, meaningfully concerned about the U.S. Fiscal situation, you should probably be a lot more long gold than you are right now. And the reason why that is, most investors, essentially something like 95% of investors have, zero or de minimis exposures to gold. And that just doesn't make any sense just from an empirical perspective, from a portfolio construction standpoint. If you look back through time, what you see is that gold outperforms bonds in about 50% of stock drawdowns. And, if you look at the last 5 years, that's basically played out. It's been a perfect case study in how gold can often be a better diversifying asset than bonds to a stock portfolio.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have an awesome discussion lined up, and we're fortunate to have with us Bob Elliott. Bob is the co-founder, CEO, and CIO of Unlimited. Prior to founding Unlimited, Bob served on the investment committee at Bridgewater Associates, which is the largest hedge fund in the world, where he created investment strategies across equities, fixed income, credit, exchange rates, and commodities. He also built and led Ray Dalio's investment research team for nearly a decade. He's the author of hundreds of Bridgewater's widely read daily observations and directly counseled some of the world's foremost policymakers and institutional investors on economic and investing issues. Bob, thank you so much for joining us today.
Thanks so much for having me. Quite the introduction.
Well, let's start with the consumer. Americans' excess savings are completely gone. 2.3 trillion of U.S. excess savings have been spent over the last 3 years. As a result, cumulative excess savings are now negative 216 billion, according to the Fed data. Meanwhile, U.S. credit card debt is a record 1.1 trillion. How fragile and dangerous of a position is the American consumer in right now?
Well, I think it really comes down to where income growth is happening in the economy, and so as long as unemployment remains moderately low, and we continue to see income growth for the consumer employment and income growth, wage growth, the current spending dynamic can likely persist, but it's really the linchpin is that employment continues to be in place and that income growth continues to be in place. And if there's a disruption to that, then that's really the risk point for most consumers. And then, of course, it's very important to recognize that while maybe an aggregate or maybe even the median consumer, is employed and experiencing some wage growth, some decent wage growth, there's a big chunk of consumers that are not those that hold assets, not those that necessarily have high-paying white-collar jobs that who are facing challenges with the cost of living, and so in that sense, the K-shaped recovery is particularly challenging for those on the bottom leg of the K.
I believe that the SOM rule was recently enacted, which is a 0.5% unemployment increase in 6 months period of time. It's predicted the last 9 recessions. You were mentioning unemployment. Are you worried about that particular issue being triggered?
I think one of the challenges with solely looking at unemployment, the unemployment rate, is that it can be influenced particularly by labor supply elements. And so we've had a substantial amount of somewhat unexpected labor supply through immigration over the course of the last couple of years. And so part of the rise in the unemployment rate has been a function of that new labor supply coming into the market. If you look at other measures, and really the Fed and others will look at a wide range of measures when they're thinking about what's going on with the labor markets. things like, share of prime-aged workers that are currently employed, that is still, at or near highs, with the biggest loosening and risk being actually amongst younger workers and those that have the lower education cohort workers as well. They're seeing a much more rapid deterioration in employment conditions than say prime-age workers or white-collar workers.
So about 59% of Americans currently believe that the world's largest economy, America, is currently in recession, according to a July survey. And maybe that's because they have no savings left. I'm not sure. But this number is extremely concerning, as consumption does account for 70% of GDP. So it's clear that the U.S. households believe the economy is in recession. Is this figure even important, or is it something that we should strongly be paying attention to?
Well, I think it ultimately comes down to the sentiment, and particularly the sentiment for households between the choice to save versus spend. When households feel like economic conditions are deteriorating or are weak, they typically make a choice to save more out of their income, which naturally it's a bit of a self-fulfilling prophecy, in the sense of, by saving more and spending less, it creates a negative cycle in an economy. And so to the extent that views of weak economic conditions are causing consumers to pull back, that could easily, create that sort of negative drag on the economy. So far, most consumers' activity is not aligned with a view that recession is afoot, or that employment conditions are rapidly deteriorating. But I think what you see there is a lot of kindling in the event that we do get a more meaningful downturn, either in asset prices or economic conditions, that could easily cause a relatively acute pullback, which could be very challenging for the Fed to reverse, if we're in that circumstance.
So Stanley Druckenmiller, he's made a huge bet shorting long-term government bonds. In fact, it's reported that 20% of his portfolio is going towards this bet. What is his bet saying to you, and what are the ramifications if he's correct?
Well, I think what the basic picture that is going on across the U.S. economy, and particularly the asset markets, is that despite the fact that inflation remains elevated compared to the Fed's mandate, the Fed has chosen basically to aggressively cut interest rates. Over the course, they've signaled that they're going to aggressively cut interest rates over the next couple of years. And I think Chairman Powell said, essentially there's only one path, one direction of interest rates ahead, and that's down. You think about that in the context of an economy that continues to have lots of inflationary pressures within it, both in terms of just the headline number that the Fed is managing policy to, which is, core PCE remains above the Fed's mandate, but also all sorts of elements under the hood of inflationary pressures that remain. You ask small businesses on Main Street, what is your primary problem? It's not sales. It's not, ability to find labor. It is inflation. That is unambiguously the case. It is inflation is their biggest problem. And so the Fed engaging in an aggressive easing cycle when that's occurring is certainly, it's an unusual set of behaviors from a central bank. And it's the sort of behaviors that would typically cause bond yields to rise, despite the fact that the Fed is cutting on the short end.
Hence the big bet by Druckenmiller. Yeah. Okay. Yep. Well, so Bob, the dollar just keeps going up. Usually moves of this magnitude carry some kind of intelligent narrative that validates the policy or economic development that's taking place, but not this one. Is it a foretell or something that something is getting ready to occur? In your analysis, what's going on here with this move by the dollar?
Well, I think everyone looks at the dollar relative to other fiat currencies. And when I'm looking at the dollar, what I'm seeing is that the dollar is actually going down, which is a bit of an odd non-consensus view. And the reason why it's going down is because it's going down against gold, right? And so, sure, the dollar's up against the yen, and it's true that U.S. conditions are better than the terrible malaise that Japan continues to experience. But when it comes to how is the dollar performing relative to hard assets, it's pretty clear that the aggressive easing stance by the Fed is translating into dollar depreciation as you'd expect. The issue is when you're looking at currencies, every central bank in the world is basically pursuing easy monetary policy and devaluing their currencies relative to stuff and hard assets. And so, the U.S. dollar may be the cleanest shirt of the dirty fiat basket, but it's definitely going to get down against hard assets.
Well said. All right. So U.S. banks' unrealized losses have soared to 7 times 2008 crisis levels. The banks seem to be taking massive hits, with their unrealized losses on their securities skyrocketing to $750 billion by Q3 of this year. Again, that's 7 times higher than the unrealized losses reported during 2008, where banks faced $100 billion in losses. Do we have an underreported banking crisis about to explode, or is this metric of unrealized losses overblown?
Well, I think that the unrealized loss reported numbers, they are they're an accurate assessment of the circumstance. The real question when you're thinking about the second and third order risks of such a situation is what are the regulators going to do about it? Because in the banking context, to the extent that banks experience losses all the time, and banks can even operate with negative equity for an extended period of time. The main risk for the banks is whether the Fed, the OCC, and others force those banks to realize those losses, essentially book those losses in terms of taking it on their equity capital. And so I think what we've seen post SVB and the I don't know what you call it, kerfuffle that happened there, not quite a crisis, but not smooth sailing either, has been a real push from U.S. bank regulators to basically sweep this risk under the rug and not recognize that it's occurring. And so banks can continue to operate just fine as long as depositors feel safe in terms of their deposits. And the Fed and the Treasury have basically made a full backstop on that element. So if there's going to be a risk, it's unlikely to repeat what we saw in 2008, given the regulatory framework that's in place in response. It's probably going to have to be outside the banking system. In many ways, the Fed and the Treasury kind of learned their lesson to not let the banks get into real trouble, no matter what it takes. And so they're at least not going to cause a challenge the way they did in 2008. So they've learned their lesson there. The question is, are they missing something that is outside of their purview?
So somebody, Bob, positioned the current situation as this: bonds are falling like the Fed is raising rates again. Gold is rising like the Fed is aggressively cutting rates. Oil prices are falling like we've entered recession. Stocks are rising like the bull market just started. Home prices are rising like inflation is rebounding. Mortgage rates are rising like the economy is strong. Did the Fed break the market or something here?
Welcome to the challenge of macro investing and trading, right? All of those cross currents all at the same time, and you got to navigate all of them. I think most of the things that you're talking about are really related to the Fed transitioning to pursuing over easy monetary policy. When you have an economy that continues to experience inflationary pressures and then you aggressively ease, either the economy can run hot and that'll create essentially bond yields selling off and mortgage rates rising and things like that, and inflation concerns, which often get reflected in gold. Or what can happen is the markets can basically get ahead of that. And so I think that's what we've seen really over the last 6 or 8 weeks, is that financial markets are looking at what the Fed's doing and they're saying money's too easy in the US, but also globally, as we see the global easing transpire. And as a result, we're going to get ahead of what we think the likely macro implications are of that dynamic. I think the main outlier is in the oil market, which honestly, since 2016 has traded a bit idiosyncratically, particularly related to supply elements. And so I don't think it's necessarily a great indication of demand or inflation pressures, and much more around where incremental supply is coming into the market.
Interesting. Okay, so let's stay on the market here. And in the market in March of 2000, Cisco and all the tech stocks, they were in a massive bubble. Cisco made up 5.5% of in all of GDP, and that was at the peak. Today, NVIDIA is worth 11.7% of US GDP. That's right now. So that's more than double where Cisco was during the biggest stock market bubble since the one that kicked off the Great Depression. How concerned are you about this, and what are your expectations for these high-flying tech stocks moving forward? Are they in a bubble?
I think when you look at what expectations are priced into the Mag 7 or other tech stocks, particularly related to AI, it's going to be quite challenging to achieve the sort of growth that's currently priced into the market. In order to achieve their expectations, you not only have to see, incredible productivity growth, which drives additional sales growth, and incredible investment growth, multiples of even what, reasonable people are penciling out. But you'd also have to see it drive huge margin expansion across the equity market. And I think one of the challenges with any expectation of margin expansion is when margins expand, it basically means that labor gets paid less relative to their overall demand. So somebody's got to make up for that. And so either households would have to save to make up for that, or the government would have to go run even larger deficits than we're already running, both of which are pretty implausible when you think about the extremity of it. And so there's no doubt that expectations are likely unreasonable across many of those tech stocks. The question is, when do bubbles pop? Because you can become quite poor shorting bubbles as they get more and more extreme. Typically, when you look back through time, what causes bubbles to eventually pop is a central bank tightening of one form or another. It certainly happened in the 2000 case. It happened in the 1929 case. It happened in the 2006 to 2008 housing crisis. And so I think we're in a challenging circumstance for the, let's say, the rational investor, seeing very elevated valuations across those stocks and very high expectations, but a circumstance where the Fed is easing that typically would not lead to that bubble being popped quite yet.
So, Bob, the Buffett indicator is now over 200%. The value of all publicly traded stocks to GDP, it's over 200%. It's the highest on record, I think. The mean is about 70%. Are we in a melt-up stage or about to enter a melt-up stage, or are you expecting a mean reversion downward to that 70% area?
Well, the general dynamic here of over easy monetary policy, it does favor stocks relative to bonds, and in part because bonds are a soft asset and stocks in some ways are a hard asset, right? If you've got to go out there and find something that will maintain its value during the risk of a higher inflationary environment, companies in part benefit from higher inflation because it means that revenues are higher, and as a result, nominal profits are higher. And so I think what we're seeing, that unusual combination of gold performing very well and stocks performing very well. In fact, I was just looking, this is the only time in history where gold is up 25% in a calendar year and stocks are up 25% in a calendar year. I mean, so it gives you a sense of how unusual what we're experiencing right now is. And so I think that's very indicative of this sort of environment where money is running too easy, and so you can have a circumstance where people are essentially moving out of huge bond portfolios, trying to find something that will maintain a storehold of wealth over time, and so you get a squeeze up in both stocks and gold.
So it sounds like bonds are the loser, and while stocks and gold still win. So the three largest companies in the S&P, Apple, NVIDIA, and Microsoft, they make up over 20% of the index. The concentrated risk is at a record high. It far out surpasses the highs in the early 80s, which I think by more than 53%, the late 1990s by more than 67%, and 2008 by more than 100%. So the concentration at the top is unparalleled. What is the risk that markets are facing as it stares down the biggest concentration bubble in history at the top of the equity pecking order here?
Yeah, what really creates a lot of idiosyncratic risk when you're buying the S&P 500, which, I think most people think I'm buying the S&P 500. It's a diverse set of stocks. It'll mostly move with the U.S. economy. And certainly a lot of passive investing is going into those assets. And essentially passive investing is simply momentum investing, right? Because you're just buying, the biggest stocks and you're chasing which stocks have gone up recently. And of course, momentum investing is often, can be a good strategy until it is not. And in this circumstance, I think what we see is a lot of idiosyncratic risk. I mean, just take NVIDIA in particular. You could easily have circumstances where, say, a regulatory constraint on the ability to sell chips into China, which is not something that is necessarily what people think that they're betting on when they're buying the S&P 500. Just that could be, a meaningful influence on NVIDIA's stock price, and then on top of it, could create a meaningful hit to the S&P 500, or say Microsoft runs into some challenges with the Department of Justice and antitrust and issues like that. There's lots of different.
Isn't NVIDIA kind of facing that right now?
Yeah, I mean, NVIDIA is also facing it related to national security issues and matters like that. The point is that, who knows whether any one particular one of these things will play out as being a drag on those particular companies. What it highlights is that you as a stock investor, as a common stock investor, essentially are significantly levered to those couple companies and the prospective risks that exist with those couple companies. And part of the idea of investing in stocks is to hold a diversified basket, because you don't know, is Pepsi going to win or Coke going to win, right? Like that's, as an investor, as a common man investor, like who knows, right? You don't want to really bet on that. You just, people will buy soda and just as they're buying everything else. And so people who are buying the S&P 500 right now have a huge implicit bet on these high flying companies.
Yeah, and I think the average investor, to your point, would like to see gains in their portfolio while having little to no risk at all.
That's right. And the further concentration you get, just almost by definition, the greater risk that you're going to experience in a portfolio. And so that's, that has created greater and greater concentration risk in the S&P 500 and likely higher volatility ahead relative to the returns that people are going to see.
Definitely something everybody should be paying attention to. So, Bob, since October of 2023, the overwhelming majority of fund flows into equities, they've gone into tech, and a lot of it has been passive at the expense of everything else, including industrials, telecom, materials, real estate, everything. These fund flows have helped to build the concentration that you just spoke about. If and when the AI bubble bursts, are you wincing at the potential flight of money out of tech? And where do you see that wall of money going?
Well, I think the challenge is that if those very high expectations get disappointed, you could have an evaporation of valuations, without frankly needing much in the way of incremental flows, right? If those earnings, those very elevated earnings expectations just don't show up, those companies can experience significant hits. And, the money isn't going to go anywhere. The valuation is just going to change to be substantially lower. And so I think one of the questions that, if you're thinking about sort of the internals of the market here, is that there's still some value in this market, which I know is hard to believe, because when you look at, top line PE numbers, you say, how can there be any value? But particularly when you start to look at companies, say in the commodity space, you see companies trading at 10 times earnings, 12 times earnings. That's a very reasonable valuation for companies that are like that. And so my guess is, to the extent that we see disappointment in some of those high flyers, we're gonna see the rotation into some of these higher quality names with good value. And so the question is basically, it's the classic challenge of, do you chase the bubble until it bursts and think that you can time that, or is now the time to take a little money off the table in those high flying names and start to move to better value in the market?
Yeah, and some have said to put it in the context of front running the masses that will eventually be coming over there. But so the baby boomers still have incredibly high stock market allocations, and the market's at all-time highs. The boomers have not recalibrated their portfolios after the last few years of explosive growth in the market. They still maintain something like 65% allocation, when at their stage of life they should be around 35%, if I'm correct. All the risk for them seems to be to the downside. They have the overwhelming majority of the wealth and the spending power in the country. If the boomers collectively experience a reverse wealth effect because of a stock market decline, that would be even more pronounced for them due to their all-in allocations. What would the cascading effects look like?
Well, I think the boomers are a critical component here in terms of wealth accumulation. And I think both for themselves and seeing, and they're spending today, right? By definition, the boomers are basically not earning any more incremental employment income, right? They're drawing down their savings. And so to the extent that they see asset price declines, that would likely meaningfully hit their desire to spend, and as a result create a negative shock in the economy. I think the other thing that is probably talked about a little less and is critically important is just how much the boomer wealth position flows through to the economic activity of younger generations. In particular, the support that boomers are giving to millennials and other and I guess older Gen Z in terms of their ability to buy houses, their ability, frankly, to keep spending going the way that it's going and not get squeezed. And a lot of those folks, the millennial and older Gen Z folks, are in many ways feeling better about their personal financial circumstance, despite the fact that they are challenged in terms of, the cash flows in and out. They feel better about their personal circumstance because they see the wealth accumulated by their parents, which can either be, supportive to them in real time, or eventually a wealth transfer would occur. And so I think if that, in a lot of ways, the boomer generation is like the linchpin of all of the rest of the economy as a function of those sort of perceived balance sheet supports to other generations.
Yeah, and I think since they are the linchpin and they are the stick holding everything up, everybody should have some kind of risk plan in place in the event that stick cracks and everything comes down. And I'm not saying collapsing majorly, but because of their allocation percentage, it could be pretty significant downstream as you're talking.
I mean, certainly if you're a boomer and you're holding 65% of your assets in stocks, that is totally irresponsible in terms of a level of risk that you're taking relative to the prospective volatility in the markets. Someone, I think about my parents and they're in their mid 70s, they're holding something on the order of 50 or 60% cash and relative, and a diversified portfolio of assets above that. So, I mean, you're talking about 10, maybe 10-ish% in stocks, which is, the right level of risk tolerance given the prospective volatility that could occur. And so if you're in that boomer class and you haven't sold your house and you're still at 65% stocks, you could easily experience 50% drawdown in your wealth. And that would, that could be catastrophic for those who are expecting current levels of wealth when they're projecting out their current spending in retirement.
And am I right? Is that the average allocation right now?
Yeah, it's in that order of magnitude. If anything, it's interesting. If anything, the boomer cohort has a higher allocation to stocks than millennials and Gen Z, which is kind of interesting. I mean, if you're a late millennial, what you've seen 2000, 2008, and 2020. It hasn't been, stocks are up relative to when you started saving, but it hasn't been an easy ride. And so actually millennials have run much more conservative allocations than boomers have, who basically saw all the benefit from, the easing that started in 1980 all the way to today.
So, Bob, billionaire John Tudor Jones on a recent CNBC interview stated that the debt situation will face a reckoning after the election. All roads lead to inflation, and that he's long gold and he's staying away from long-dated treasuries. Is he right? Do all roads lead to inflation and we all need to be long gold?
Well, the first thing I'd say is that even if you're not meaningfully concerned about the U.S. Fiscal situation, you should probably be a lot more long gold than you are right now. And the reason why that is, most investors, essentially something like 95% of investors have, zero or de minimis exposures to gold. And that just doesn't make any sense just from an empirical perspective, from a portfolio construction standpoint. If you look back through time, what you see is that gold outperforms bonds in about 50% of stock drawdowns. And, if you look at the last 5 years, that's basically played out. It's been a perfect case study in how gold can often be a better diversifying asset than bonds to a stock portfolio. And so I'd say the vast majority of folks are totally underweight gold, and they should be adding that to their allocation. 5 or 10% gives you actually a lot of bang for the buck when you think about, from a portfolio construction standpoint. And, doesn't mean that you're a gold bug, just means you're building a prudent asset allocation. Now, I think more tactically, I think what's being highlighted there is, in an environment of relatively large fiscal deficits, elevated inflation, you'd expect to see a transition of savings from the U.S. bond market into hard assets, both from U.S. Investors, but also from global investors who have built up huge bond portfolios like global central banks and are asking themselves, do I really think I'm going to be paid back in real terms the way I expect? And those investors are relatively critical for driving the market between essentially gold and bonds. And we've seen them aggressively bid gold during this period.
So gold has significantly outperformed all three major U.S. indices over the last 25 years. Gold is up about 830%. NASDAQ is up about 580%. The S&P is up about 320%. And the Dow is up about 290%. Yet mainstream media hardly ever even mentions gold. Why is that?
Well, I think there's probably two reasons. One, there is sort of this view that when you start talking about gold, like it's the equivalent of talking about like living in a small cabin in the Adirondacks, surrounded with guns and water and, prepared for the apocalypse, which is, kind of silly since just the empirical outcomes, the empirical analysis of gold as a financial asset, demonstrates that it makes sense to hold. I think also people get confused that they look at gold and they say, well, it's not a yielding asset, the way stocks and bonds offer a yield. And what I'd emphasize there is that part of your return in any asset can be a function of the yield and of the principal. And to the extent that gold by its definition doesn't offer a yield, that can be made up for in the spot move in the price. I mean, look, gold hasn't offered a yield at all this year, and it's up 50%, 60% against long-term treasuries, right? So it's not the yield that determines the total return. It's the combination of the price move plus the yield that determines the total return. And so you put those two things together, and as long as the price return offsets whatever yield you're getting on bonds and then some, it's an attractive asset to be holding.
Maybe the counter to that for somebody who's retired and not having an income but drawing off their investments is that the yield in the bonds is providing a monthly cash flow, whereas the no yield in gold is not providing anything.
Yeah, I think there's some structuring points there. If you want to get tactical on that, there's good reason for why you would actually want to generally not take yield from a tax inefficiency perspective, right? You want to have about as much compounded, as long as you leave assets intact, right? You have the ability to essentially compound before paying capital gains. But when you take dividends, you essentially pay for it immediately. And so the challenge with dividends or coupons is that you don't get the choice of whether or not to take the gain at that time. Whereas when you have an asset which has, which is basically capital gains, which you eventually sell and take the capital gains, you have control over when you pay the taxes. And so just simply, I mean, it doesn't really matter from an economic return perspective, but when you start to think about taxes and when you have to pay taxes and when you don't have to pay taxes, if anything, you're advantaged by having primarily capital gains assets in your portfolio.
So, Bob, gold as a percentage of equity within ETFs hit a high in 2011, around 18%. It then fell, and then it fell until 2013, where it hit about 4%. And then it stayed in that range for quite a long time. Today, it's a shade under 3%. So it's about 85% off its peak high in 2011. Clearly, there's no bubble there. Do you expect gold to continue to rise and eventually end up back in a bubble phase the way it did between 2008 and 2011?
Well, I think what you're highlighting is, at least in the West, there really is no bubble in gold. People see a price rise and they say the price is high and stock prices are high, and so they must both be in a bubble. But the ownership, particularly amongst Western investors, of those two assets is radically different, in the sense of the ownership of U.S. stocks is basically at all-time highs amongst U.S.-based investors. Whereas, as you note, the ownership of gold as a share of your portfolio, as a share of portfolios, is basically at all-time lows or multi-decade lows. Right. And so, despite the fact that the price has risen, those two positions are very different. And so I think there's a lot of opportunity for gold prices to press higher here before investors are really overweight, or it's even close to a bubble in the market.
Yeah, agreed. So gold roots, they're growing. That much is clear. From the BRICS to central banks to billionaires, and now even beginning to spread to the Western investor. I believe that in the ETFs, they're up for 4 months in a row. It's a slow process, but it's underway. As gold develops deeper roots, does it risk materially fragmenting the global system and eroding the international influence of the dollar and the U.S. financial system? And if so, won't that have an impact on the U.S.'s ability to inform and influence outcomes and even undermine national security?
Yeah, well, I think we're a long way from gold being essentially a challenge to the dollar, and part of that story is that on a global basis, most global international companies have borrowed in dollars. Most international savers are saving in dollars if they need an asset to save in. And there's vastly more dollars out there than there is money in gold, particularly if you add in or think about dollar denominated bonds as a savings vehicle. And so I think the real play in terms of the price that we see in gold and essentially the price or the yield that we see in bonds is really about the incremental choice between saving in dollars and saving in gold. And that's where even modest shifts in the incremental choice. I mean, just think about it. There's $50 trillion of government bonds, amongst the major liquid global government bond markets. That's a huge number relative to, a pretty modest hundreds of billions of dollars in terms of monetary demand for gold on an annual basis. So if you just think about that, it doesn't take a lot of incremental desired diversification from the global government bond markets to hard assets to create a real squeeze in those markets.
Is that exactly what you're expecting?
Well, I think that is that is the most likely circumstance, given the path of global monetary policy that's going on right now and the various macroeconomic pressures. I think one of the challenges, anytime you're talking about an asset like gold, I like to say, gold's an asset to hold, not to trade. And the reason why I say that is that, any one day there might be more or less demand, or interest rates might go up or down, and that might have an effect supporting or taking a drag on gold. But what is critical from a long-term saver's perspective is essentially a view that not only does gold provide a provide a beneficial diversification tool when you look back through time, but that there's good common sense reasons over time why we're going to see people move from more fiat currencies across the developed and emerging world and towards hard assets, given the amount of indebtedness that exists and the easy monetary policy that looks to be playing out over time.
So, Bob, the long-term gold to silver ratio chart shows that silver is currently significantly undervalued compared to gold. It indicates that silver has much more room to rise in order to catch up. If the ratio were to revert to its historical average, it would be around 52.8, and that is since 1915. That's without any increase in gold's price. Silver would be valued right around $51.50 per ounce. Of course, that's also a very far cry below the inflation-adjusted high of about $185. Instead, silver's trading under $34 today. What's your analysis pointing to for silver?
Yeah, I haven't traded silver. I'm not a big, not a close follower of the market. In part because, I think silver is meaningfully influenced by industrial demand beyond monetary demand. What I would say is that I think smart people that I follow in thinking who are thinking about silver and much closer to the market highlight that there are good reasons to believe that there may be not only the monetary demand that you outlined, but also increasing industrial demand as part of the global energy transitions and things like that could create an additional benefit for the metal. That essentially gold is a bet on monetary policy.
Yeah, and the higher gold goes, there are going to be some people, correct me if I'm wrong, that are going to look at the price of gold, whether that's 3,000, 3,500 or higher, whatever that number is, and they're going to say, well, that's too high. I missed my opportunity. Oh, wait, here's silver. It's 35, it's $50, whatever. I could buy that instead.
Yeah, I could easily see that. There's certainly an interplay between the two, even if the ratio is depressed to some extent relative to history. And it's sort of natural for investors to who are trying to catch a theme to try and find the where in the market are they seeing better value from their perspective. And so it makes sense to me that might create flows into the silver market as well.
Some analysts are reporting that there's a huge disconnect between gold mining stocks and the yellow metal itself. They're calling it the golden value gap, and they're saying that it's probably the decade's biggest opportunity. What is your analysis pointing to for the miners?
Yeah, from a macro investing perspective, I've typically only traded the metal rather than the miners, and the primary reason why that is because when you're betting on miners, what you see is that you're not just betting on the top line, essentially the revenue, but you're also betting on the cost structure and how effective they are in terms of their productivity of production. And so, miners may be good at that and they may be bad at that. And so you have to have a view on that element if you're going to trade the miners. If you're looking for more leverage in gold, you can use things like futures and options, which would allow you to have greater notional economic exposure or, an exposure to particular upside moves without having to necessarily make a bet on the idiosyncrasies of mining production that exists in the miners.
So, Bob, the setup today that you've been discussing, that you've been sharing on, it seems to be one that many precious metals and commodities investors have been waiting several years for. Gold's broken out, silver's starting to break out, the Fed tightening cycle's over, the loosening cycle is underway. Fiscal problems for the U.S. federal government are going to lead to what many believe will be another big print by the Fed. What happens to the prices of all of these real things, commodities, metals, miners, et cetera? What happens if another big print occurs?
Well, I think what we've experienced from an investment perspective over the course of the last 15 years or so has been really this move from hard assets to soft assets and technology type assets. And the reality is that when when we have monetary challenges, people for thousands of years have gone to the safest storeholds of wealth that they can find. And, it's not surprising, for instance, that local Chinese residents, when faced with a difficult depression type environment there, they look at houses and they say, not a good bet. They look at stocks and they say, not a good bet. They look at the bond market or the banks in their economy. They say, not a good bet. When it comes down to it, what do they go to? They go to gold. And that's because, it has been a storehold of wealth and a savings vehicle for thousands of years. The value of a gold bar and what you can get from a gold bar today is essentially the same as what it was in Roman times. And so I think when people see, frankly, the chaos and the craziness that exists around them from a monetary perspective, and they compare that to what has been the long-term staying power of gold, they find it very compelling, and we're likely to see more investors move in that direction.
Well said. Well, this has been a wonderful conversation. Before we wrap up here and I ask Bob our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on an important Ray Dalio foundational premise. And by the way, this is not just for today. This is always. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive you've enjoyed the conversation with Bob as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. It's now time for our Golden Nuggets segment. Bob, let's discuss portfolio positioning based on all we've discussed today, and with your experience and your worldview as the backdrop. How are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
Well, I think the primary story ahead is to underweight bonds and to overweight stocks and gold, and that this period of over easy monetary policy, which the Fed is essentially committed to, is an unusual circumstance for most developed world economies, but it is not an unheard of circumstance, and you can look back and see how this has played out in other areas, particularly in emerging markets who have pursued similar policies. And the way that that's worked out is that investors move away from their bonds, they move away from their currency, and they move to hard assets that will provide a long-term savings, long-term storehold of wealth, and that's really stocks, which are income producing, as well as hard assets like real estate and gold. And so that's really that's the basic picture that we're in. And while that can feel a bit scary, it's a well understood dynamic, and eventually that may turn. Eventually the Fed may shift back to a tighter monetary policy stance. But until the Fed does, you really want to be careful about being overweight, particularly long-term bonds in this circumstance.
Bob, thank you so much for coming on to Metals and Miners and for being so generous with your time and analysis and ideas. It's been awesome to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Yeah, for sure. If folks found this interesting, and are also interested in sort of a running flow of various macro takes, which I write on a regular basis. I'm very active on Twitter, the handle BOB Unlimited. I'm also clips of various media appearances and interviews, as well as a monthly macro outlook you can find on my YouTube channel, which is at BOB Unlimited. And just new this week, started up a TikTok where I go through and talk about on a morning, every morning, breakfast with Bob, what's going on in terms of the markets and what I'm seeing for the day ahead. So definitely check that out if TikTok is your thing.
Well, awesome. Hey, I will have all of that information up on the screen. There'll be links for everybody to click through in the description area. I've been following you, Bob, for a couple of years. I really appreciate your perspectives and your viewpoints and your information. Everybody needs to be following you who's in this space. So anyway, I look forward to having you back on sometime soon. Thank you for being here with us, and everybody else, thank you for watching.
Thanks so much for having me.